The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. It's Paul here. Here we are on Monday, 28th of January 2019 for session 24 of the Admiral Markets webinar series on mastering the 4 M's of trading. I said I'm Paul Wallace. I'm a trader and coach, and I'm the guide through this Admiral Markets webinar series. And as always, I look to begin with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying video is for information and educational purposes only. Online educational materials are developed by Admiral Markets and distributed by Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with a maximum payout of £50,000 sterling as per our negative balance protection policy. There are several good reasons to trade with Admiral Markets as one of your main brokers. They, as you can see there, they offer very, very competitive spreads on the very popular trading instruments of Euro Dollar on DAX 30. They also offer the MT4 and MT5 platform with the old Admiral Markets Supreme Edition. If you have any questions, please get in touch with the account representative and they'll be happy to guide you through. And as Admiral Markets is a global brokerage, okay, it's one world, global offers. They are regulated throughout various trading environments throughout the world. If you have a chat with your account representative, they'll be very happy to guide you to select the most suitable environment for yourself. So, as always, ladies and gentlemen, my expectations, okay, for me, for the session, I'm here to educate you about the 4 M's of trading so you can go away and analyze markets and be ready to trade them and also help you raise your own self-awareness about managing risk and managing yourself. For you, ladies and gentlemen, I just ask that, I appreciate we have a broad range of experience in the room and that we're, operate under time limitations of 45 minutes so that, can't always go into topics with the depth that some people would request. But what I like to try and do is sort of focus on tools that all of you can use tomorrow in your own trading sessions. That's what this is about. It's about helping you develop your own trading business, and in doing so, you becoming the best version of your trading self. So 4 M's of trading is pretty much what everybody's looking for, and why we're here at this Admiral Markets webinar series is that, if you're in the ability to understand and master the 4 M's of trading, which are markets, method, money, and myself, well, when you're in a good spot and top of all those 4 areas, that is invariably when we tend to trade at our best. If you're having some trading challenges, well, then, it's important to have a look into those 4 areas to understand which one of those areas are you having particular challenges with at that moment. So, for the first half of the webinar series, we focused a lot on sort of markets and method, and in particular, we talked about building good trading habits. All right, now every week I put this up in terms of we were talking about having sort of 10 steps that a trader could have in terms of helping them master those 4 M's of trading, and we spent the first part of the series really looking into that and how we can build those steps up so that we have an automatic process that we can follow every time we sit down to trade. So we're looking there. Step 1: whenever you open a chart, okay, regardless of regardless of whether you're a monthly trader of gold, or you're an intraday trader of 5-minute charts on euro dollar. All you need to be doing is defining your levels of support and resistance. Step 2, defining if there is a trend. Step 3, wait to see how price reacts at those key support and resistance levels. Step 4, look for particular price action signals that at those levels, and also be aware of are they part of a bigger chart pattern. So all of the sessions that covered those particular steps in greater detail, they are all in the webinar archive. You can find them on the Admiral Markets YouTube page and also on the Admiral Markets Facebook page as well. So I thought today, I'm gonna sort of recover sort of risk and reward, because I just think they're so crucially important. But what I also do is, we'll go through them as a recap. What I also wanted to talk about later on is maybe giving you a little bit of an understanding of a flavour of how that all comes together in a particular trade, and just having a little bit of a sort of going through the anatomy of a trade of one of my own trades from last week, right, on the 4-hour pound against dollar. And we can look forward to that. Once we've gone through the slides, I'll switch across to the charts, and we can have a little bit of a look to try and help give those traders who are, let's say, new to the sort of the trading career a little bit of a better understanding about how we can use the tools that we've talked about in the Admiral Markets webinar series, but also in particular looking about how we understand where our risk and reward, how we need to manage them in our particular trades. So if you remember, for the last few weeks, we've talked primarily about, risk. Step 6 was risk and step 7 was reward. What we wanted to talk about was, the fact that, you're a trader, ladies and gentlemen, okay? It's your job to take risks, and it's therefore your job to manage risk. And, I've said it the last few weeks, the better you become at managing risk, the quicker your progression will be to profitable trader. Lots of, new traders think it's all about, picking the superstar trade, trying to hit a home run off it. But actually what you find is professionals are all about managing risk. Okay, you're managing risk first, you play good defense first, and then that allows you the opportunity to go and score some home runs. We talked about sort of building a couple of little simple rules into your overall risk management principles. First one being that you want to live to fight it another day. You don't want to get shot down nice and easily, okay, in your trading. You want to live to fight another day. And you also want to find second rule was never ever find yourself in a trade without an exit plan. That was the other two, just two very, very simple rules to begin with, just to make sure that you are sort of covering off the risk management basis whenever you look down to sit and trade or engage with financial markets. So I talked about how, as I said a little bit there, sort of new traders, they're always thinking about entries. They're always, intrigued and interested and wanting to know more about entries. Whereas professional traders, they're always focusing on the exits, all right? And in particular, they're thinking about, well, where we get out when we're wrong and where we get out when we're fortunate enough to be right in our trades, and about being able to manage them. That is one of the things that helps us, become helps us edge to our way towards trading mastery. So, just to talk about in these recap slides is that, risk profile is a very personal thing, okay? You'll find myself and the other educators that are here providing excellent content for you as clients of Admiral Markets. We can teach you pretty much everything. We can tell you, a huge broad range and spectrum of educational elements. But the one thing that has to come from yourself, the one thing we can't teach you, is about your own particular risk profile. Some people are very aggressive. Some people are very cautious around risk, okay? It's about trying to understand who you are. It's about understanding about being able to sort of work within those boundaries. It's no use trying to fight yourself. That never really ends very well for, in any endeavor in life. But what we talked about is, is just having a very simple sort of rule of thumb, okay, for you in terms of how much you risk on a particular trade. And if you want to go back into that in more detail, as I said, you can find sort of, I think, sessions are sort of 21, 22, 23. Okay, it was that we dug into this in a great deal more detail. Is that but the simple rule of thumb is that we never look to risk more than 1% of our trading capital on a single trade. And we go through how we actually define that. And hopefully you'll be able to, if you are just new to the series, hopefully you can go back and sort of check up on those in the archive. And that will give you all the insight you require about that. So what we also talked about is money management is actually one of the simpler topics to grasp within trading. It's actually not that difficult, but very often I find traders, especially greed-based traders, who we talked about in one of the earlier sessions, they find it very hard to follow because they're driven by greed. But very often new traders, they lose money simply because they've got no understanding of, or they place no importance on risk management. And this is key. This is what starts to separate, let's say, the sort of hobbyists from the professionals, right? The professionals are always looking to manage risk. And without that sense of money management, traders will hold on to losing positions for an extremely long amount of time, but take profits on winning positions far too prematurely. And that kind of links into next week's session, which is about understanding the in depth of the risk to reward ratio. We also talked about, making sure that, prevent catastrophic loss, which was, about using stop losses. That's what we talked about, and we covered that a lot more in one of the sessions, but I'm going to touch on it sort of today. And we talked about how, we can use technical analysis. We can use our charts to define where we place our stop loss. Okay, that's our. Remember, we never enter a trade without an exit. We always we know where we're getting in. We know where we're getting out when we're wrong, getting out when we're right. There's lots of different areas there, various types of technical stops. And what we'll try and do is I'll have a little look at a few charts today. Okay, I think we've done quite a lot of let's say theoretical work. Let's have a look at some charts. Everybody likes to have a look at some charts, and we'll have a little talk through the different types of technical stop losses. So what we talked about, okay, and remember, and one of the reasons I go through quite a few of these slides, again and again, is because the more you hear it, the more it sinks in, the more it becomes just your natural way of operating, and I need that to be your natural way of operating. That actually, your risk management is just absolutely spot on. Trade after trade, that's what we're looking for. So, we talked about, we always want to try and quantify our trade risk, and we can do that, by, once we understand where our stop loss is going to be placed, because then we have an idea of where our entry price is, and also where we know where our exit price is if we're wrong, okay, if the trade idea doesn't work out on that. That happens to all traders, and that it allows us the opportunity to quantify our trade risk. Then once we know where we're getting in, and once we know where we're getting wrong, we have an opportunity to effectively, quantify our reward, right, which is, our entry price versus the exit price at a target, or at least, a sort of preceding level of, support resistance if we're going to be looking to sort of trail our stop, which we'll have a little reminder of in a slide or two. And then that allows us to sort of calculate our risk to reward, right? Very often, sometimes people call it the 3R, risk to reward ratio. Next week, I'm actually going to talk about that in more depth, okay? Understanding the risk to reward ratio, because some people get it very, very wrong. And I think it's actually quite a simple thing to understand, but sometimes some traders have a difficulty in sticking with it. So, we identified that. We also wanted to be able to do, we did position sizing a few sessions back. And how did we understand about, position sizing? Well, that was, our trade risk, okay, which is actually, is the number of pips between our, entry and our exit divided by our capital risk, okay. Remember what we said a few slides back. Our capital risk is simply that we never risk more than 1% of our account on any single trade. And once we're able to do those numbers, well, that allows us to, give us our position size, okay. That's identifies, what kind of size we can actually trade at in order to meet our risk management principles. So as I said, it's a simple topic. Step 6 is actually a pretty simple topic to grasp, but it can be hard for some traders to follow it. You can overcome a lot of bad luck with proper money management techniques. That's very true. Okay, all traders have a string of trades that don't work out that are business expenses. All traders have that. If they say they don't, then they're probably not being entirely truthful. All traders will have what professional traders would call clusters, and you're able to overcome clusters quite simply with some good proper money management techniques. And what that does is it allows you to stay in the game. That allows you to stay trading. It allows you to live to fight another day. Remember rule 1, and that then gives you the opportunity to develop the skills and experience to profit from your markets. So, and I say this every time, I talk about risk management. If you only take two things from the entire series, is that, you never risk more than 1% on any trade. You never ever trade without a stop loss. And by doing that, you give yourself the opportunity to, to survive, to prosper. So that was a quick bit on the risk. But then, last week we talked particularly about step 7, which was rewards. So where step 6 is all about where we get out when we're wrong. If you remember, step 7 was about where do we get out when we're fortunate enough to be right. And if we talked about it last week, we boiled it down to two very kind of simple, views on it. In terms of your reward, in terms of where your exit is when you're right in your trade idea, you've got one of two sort of ways to do it. You're either going to have a target in place, or you're going to have a trailing stop, which becomes which what allows you to stay in the trade longer. If you remember, targeting, it gives you a little bit of certainty. It allows you to trade hands off, in terms of you can fire and forget, which means it takes less time, which means you have less psychological capital engaged with it. It also, gives you less opportunity to interfere with your trades. Humans, we love to interfere because it's the ego playing tricks on us. It's the ego telling us we know better than the market, and more often than not, we don't. And also, for some traders, it actually just becomes easier to follow, right? You know where you're getting in when you're right. You know where you're getting out when you're you know where you're getting in. You know where you're getting out when you're wrong. You know where you're getting out when you're right. Okay, and it becomes easier to follow. And as I said earlier, it allows you to almost like fire and forget in terms of your trades. Whereas, a trailing, if you're using a trailing, what would become, initially become a stop loss, which would then you'd hope would become a stop profit. It allows you to stay with that trade longer, which of course means that you have the possibility of higher profits. Also, so for some traders, it gives them a bit of a locus of control. They think that they are in control of their position. It gives them a sort of a fleeting understanding or a fleeting, feeling of being in control, which is, my opinion is that's not really the case. And for some people, actually having a trailing stop profit is actually easier to follow. It's easy for them to follow because it can be quite mechanical, quite simple, and they just find it very easy to do that. So what I talked about last week in particular about it was just saying that in terms of whether you use a target, whether you use a trailing stop profit, there is no perfection. Okay, there is no perfection. It's about which one of those actually works best for you. Which one of those can you sort of execute consistently, trade after trade after trade? That is actually becomes much more important. I think the crucial thing is that you decide on your approach before the trade is even placed. What you don't want is effectively to get into a trade where you effectively have a trailing stop loss or a trailing stop profit is your step 7 reward exit, but then actually as the trade goes on, it starts moving and you think, well, I'm just going to reach for a 2-to-1 target now and get out when it hits that. Okay, what we don't want is when trades are open and markets are moving fast, it becomes very easy to make poor impulsive decisions. The important thing is to effectively decide your approach before your trade is even placed and then stick with it. Okay, and if that means you have to do 20, 50, 100 trades, all right, with either a target or trailing, that's what you do, and then you have a greater load of data to be able to sort of sit back and actually work with and analyze and determine which is the more suitable way for you to trade. But yeah, the important thing is that your exit is decided before the trade is even placed. So it's as I said, there is just a little bit. It's important to plan the trade and trade your plan. You don't let your reward be decided when the trade is open, or you change tacks once the trade is up and running. Have a plan and stick with it. Find something that's easy for you to consistently repeat. Think about samples of trades rather than the outcome. It's as I said earlier, there is no perfection. I personally Personally, I like to use targets because for a couple of reasons. One, I'm ex-military. I like to hit a target. Two, I actually, because I can quite often have to maybe sort of travel with work, or I might be working with clients, okay, or with other traders. Well, then actually I can just place my trade and I can almost, as I say, fire and forget. So long as I can check that the trade was on, that my stop loss is in the right place, that my target is in the correct place, and that it's still on the platform, and that everything's working. I know that actually, the trade is position sized properly, and I can actually almost walk away from it if I needed to be, if I was traveling or if I had something going on. So that kind of suits me, and it suits my personality, it suits my lifestyle. Other traders will swear blindly by having a trailing stop profit, because they know that they will have a few trades that just run and run and run and run, and that makes that's what makes a big step change in their equity curve. And that's perfectly all right. As I said, there is no perfection. There's no perfection. It's about what is the easiest one for you to consistently execute, trade after trade after trade. That is more important to me. Okay, that's what I want to see from a trader, that they can consistently repeat it rather than just constantly changing, trade after trade after trade, because that doesn't really help. So, as I said, we've been touching on risk management, trade management, money management, okay? And then also we're going to start to sort of, for the rest of the 10 steps, in terms of step 8, steps 9, step 10, and then onwards, we're going to focus a bit more on how we manage ourselves, okay? How we manage performance, how we recover from slumps, how we improve our performance based upon the data that our trades are giving us. And then later in the series, we'll have a little bit of look at shorter term trading, and also some other kind of, let's say, advanced trading tactics which you can add to your armory. As always, the big picture recap is that you remember to always be managing the 4 M's of trading, right? Markets, method, money, and myself. Always be asking yourself, is it in alignment? Okay. If they're not in alignment, then you shouldn't be expecting, great trading periods. All right. It's important to monitor those 4 areas. And you can do that to whatever level you are comfortable with. Some people will do it very simply by just asking themselves at the end of the week, how did they get on managing those 4 M's? Others will go into great detail with each of those 4 M's, okay, and there is the opportunity for you to operate, how in line with how you are. But I think just the important thing is that you at least acknowledge those 4 M's of trading, and that you make sure that you're just checking in with them, especially if you're having a bit of a challenging period. So, as always, if you have any questions about either this webinar or the sort of wide range of products and services that Admiral Markets can offer you, then by all means get in touch with your account representative. You can give them a call on that London number, 020-726-4003. Email them at hello@admiralmarkets.com. As I said, you can get onto their YouTube page, youtube.com/Admiral Markets, which has all of the previous of the Mastering 4 M's of Trading webinar sessions, but also has a wide range of other content available. And that content is also on their Facebook page, facebook.com/Admiral Markets Global. So, as I said, I want to do a quick recap on risk and reward, because I just think it's crucially important that you understand it as new traders, and that it's almost like drilled into your head that how crucial it is for your trading business. And then I thought, why don't we switch across to the charts, ladies and gentlemen? Let's go and actually have a look at some charts, have a look at some ideas. I appreciate that some people might not have that much experience in terms of understanding how they trade and place stop losses. So let's have a little bit of a look at that, shall we? So if you just bear with me a second, we'll just switch across to the chart and see what's going on in the world. Okay, super. So here we go. Here is the Admiral Markets MetaTrader 4 platform. Very ubiquitous platform. Okay, very most people have heard of it or had some exposure to it. If you want to learn more about how I use it for my own particular trading ideas, well then by all means come and join me on the Tuesday morning, 10 o'clock London time, the real-time daily trading ideas. That's when I give my sort of little look at the markets. And then particularly, I'm always interested to do my own little bit of an analysis constantly. And what I've got here is, this is just a profile. Okay, maybe this is an opportunity to talk a little bit about this for new traders. Is that within MetaTrader 4, I have a bit of a range of profiles there. This profile is a US dollar profile. Okay, you can see it there for the names. And literally what it is it's the US dollar against the other major FX currencies. Okay, so I have Aussie against the dollar, pound against the dollar, euro against the dollar here, dollar against CAD, dollar against yen, dollar against Swiss franc, Kiwi against the US dollar, and then here I have the actual US dollar index. So just looking at all these, I think I've got these are all on 4-hour charts. Okay, so these are all on 4-hour charts. So let me just tidy up that the trades there. Let me just tidy that up of the dollar yen there. Okay, so you can see here, the dollar index is bottom right, okay, in the 4-hour chart, okay, for the last few sessions. So you're really looking at the last sort of since probably about Thursday into Friday of last week, starting this week. We've had a little bit of a sell-off in the dollar index. Okay, that shouldn't be a surprise when we've seen here pound against dollar has been going up. Okay, we've had Aussie. I'll just zoom in against that. Okay, we've had strong Aussie against the US dollar. Dollar against the CAD. Okay, here we can see dollar has dropped, whereas the it's showing the CAD is strengthening. Even the euro, okay, we showed a strengthening against the US dollar. Dollar, here was just weakening against the yen. It was weakening against the Swiss franc, okay, and also weakening against the Kiwi dollar. So one of the reasons I set up profiles like this, and I recommend them to all traders, is that very quickly I can just at a glance get an indication of where the strength and the weaknesses across the sort of the major FX pairs. I've talked about it a little bit, maybe once or twice in earlier sessions, and also on the real-time daily trading ideas. Is that if you're going to be trading FX, you need to have you need to have a healthy respect for the dollar index and for what the dollar is doing, because it's pretty much the big daddy, okay. And when that's moving, right, well then you need to know where you stand. So that gives us elements of correlation, which is something we'll touch on in a future session. We can see that there's a pretty good correlation there in terms of when we see dollar strengthening, or in this particular case dollar weakening, you can see that effectively also shows out across the vast majority of the other major FX pairs. So that that's just giving you confidence, okay. Just giving you confidence that the sort of the what you're looking for in terms of your trade idea is likely to sort of play out there. So I thought what I'd talk about is, I'll talk about a few ideas, okay, and what I was looking at, okay. Just so I appreciate that sometimes it helps to put all of the trade ideas together. This is as per the disclaimer. This is just this in particular case it's a demo account, Admiral Markets, MetaTrader 4. So this is pound against the dollar on the 4-hour chart, and this was a trade I was looking at last week that we worked on and ran. And the pound has, despite pound being a rather volatile pair over the last year, especially over the last 3 to 4 months, as the sort of shenanigans around Brexit have continued on, it has also provided some opportunities for us as well. And excuse me, depending upon your particular viewpoint, we have seen sterling strengthen over the last few weeks. Whether it's strengthening because there is the view that a softer Brexit is coming, it might be one idea, or maybe it's strengthening because actually, with Mrs. May losing her vote, the now default position is that there will be what is termed a hard Brexit, okay, where the UK exiting the European Union on and operating on world WTO trading terms, and that might be also be seen as what has led to a bit of a strengthening in sterling, especially if you look at that compared to the euro, which has weakened considerably over the last couple of weeks. So that would filter into a view that actually at this particular moment, that basically a no deal Brexit would effectively be harder on the European Union than on the UK to begin with. But that's all well and well. All well and by what we hear is, this was in a little bit of an uptrend, okay, and here we had, I think this was last Tuesday morning, and we were just getting ready to sort of trade. And I was looking actually, what I wanted here. This is, we had a trade here, which was a bit of an engulfing candle. Okay, it was also, after a pullback and an uptrend. Okay, so I was very happy to be long on pound. Pound was strong across the board. So there's a great deal of strength going on there, and this was just a very simple one of my own sort of very simple mechanical trading strategies. And when this trade completed, okay, it was after the pullback, in an uptrend. I wanted to be a buyer once the market had particularly closed, and certainly closed above that 20-period moving average. So I knew that where my entry was. I knew where my entry was, but now I need to work out, do my risk management. I need to work out, okay, what is my risk management, okay, what is my trade management, okay. I know where I'm getting in. Now I need to know where am I getting out when I'm wrong, and where am I going out when I'm right, okay. So in terms of getting out where I'm wrong, that's the important thing. Well, in this particular case, it was quite simple for me, because actually what I was looking for was to effectively just to my stop loss, okay, my idea that the trade would not be working out would actually be beneath the actual candle itself. As I said, you have to excuse my line drawing. I assure you I'm a better trader than I am an artist, but hopefully you'll get the idea, and we can see that this trade set up here, okay, and I was looking at and knowing that the low of that candle was what 28.50, call it 28.54. All right. So I knew that basically my stop loss, I wanted it to be sort of 2 points beneath the low of that. So at 28 kind of 52. Let's just type this up on this one here. Just show you where you can see it. So it's just there, and I'll just show you where. Just here we go. Let's just draw another line on here to when it entered, because it literally basically entered on the opening of the next candle. That was the particular plan. Here we go. 13. Just draw this in for you, and let's put a little bit of text around it so you can actually see. Okay. So hopefully there we go. Okay. There we go. You can see that. So hopefully you can see my entries at 129.13, stop losses at 28.52. Okay. So what we had here was in terms of my trade risk. Okay. Remember, my trade risk is the number of in this particular case for an FX player, the number of pips between my entry and my stop loss. Okay. So there we had 61 pips there. Okay. 61 pips there of let's just see if we can use it up on here. Let's see if we've got this great tool. There you go. As I said, I'm a better trader than I am an artist, so please excuse my here we go. So there you go. So please excuse my handwriting on this, but you get the idea. Okay. So I knew that I had 61 pips of trade risk. Now, what I also want to do is I want to know what my target is. As I said, I personally prefer to use targets. Okay, I personally prefer to use targets. So, and for me, what I normally like to do is, where I will have my entry, I'll draw a particular fib, and actually what I'll do is I will have a target based upon sort of a fib extension. Okay, a very, very simple one. And in this particular case, what I actually wanted was, as much as I would have liked to. As much as I would have liked to have had a nice target up here, the reality was that my target was actually just in front, and the reason my target was just in front is because we were just running up to the sort of the big 130 sort of big round psychological number, right? So I had a target there at 29.98 just in front of it, because I thought that actually it might have a bit of time sort of working around it. There we go. Let's just put this up here. There we go. So what we were looking for was just to have that target there for us. So in this particular case, what we had was 85 pips of profit target. Okay, that was our simple target. As I said, normally I would like to run it longer, but because we're in front of the big 130 number, my target was drawn in more than I would normally particularly like. But actually, as you can see, pretty much almost like the next day, it hit my the target, and that was kind of it's a nice easy trade. But you can see yourself, ladies and gentlemen, that actually it's continued to go much higher. In that particular case, it's 132.17 was the highs we saw on Friday. So effectively, it had gone for about just over about 300 pips, okay, for a risk of 60. So there was a 5-to-1 trade there, but because of the sort of volatility within sterling, and also because we were just sat in front of that 130 number, I had a much tighter target than I would normally have. Excuse me, but you can see that actually, not only did it, but it actually, I cut my target short, and this is, one of the downsides of having a target in place. Okay, whilst it gives you an element of certainty and you can fire and forget your trade, what you always have to realize is that the downside is that in this particular case, you could actually have you cut yourself off from some pretty significant profits. That's what happens. As I said, there's no perfection, ladies and gentlemen. There isn't any perfection. All I can do is show you the different ways that you can enact that within your own particular trading to give you that sort of the opportunity to work out which is the best way for yourself. For those of you who would like to have used a trailing stop, okay, well, there are many ways you can do that. I'm just going to take this off here, okay. So what we might have done is I like to use fractals, okay. We touched upon them in one of the earlier sessions on the sort of Mastering Forex webinars, okay. You can see them here, these little applets here and there. If you don't know how to find them on the sort of MetaTrader 4 platform, go down to indicators, go down to Bill Williams, and then you should see them there. You can just select them and change their colors. I've just made them a little bit darker, okay, but you can see them here. So very often a very simple sort of trade, if you wanted to use a sort of very simple trailing stop, well, actually, what you could do is, you would just invariably move your stop loss every time that the sort of market printed a new fractal. In this case, because we're in an uptrend, we'd be looking at every down fractal. So invariably that would be, we'd move our first trade, our first stop loss would be moved here, and then actually what would be moved here, okay. And then actually what would happen is our next one would be here. So at this particular moment, it would actually, you'd actually sort of, you'd still be in the trade, and your stop loss would be normally, normally a sort of, 2 to 3 pips beneath the low of the fractal. So in that particular case, your stop losses at the moment probably around about 130.58. So you're 130.58. So you're about just 100 odd points away, 100 pips away from where the market is. And you've of course you've now with your let's call it your stop profit. Why don't we just move this up here so you can just see this. Let's just put it there. Okay, so you can see, that would have been moved there as as you're just trailing. Okay, you're just trailing your what is initially your stop loss, which becomes your stop profit. Okay, as it moves into a positive territory, and then as that moves on, you'd still be in that particular trade, and what you'd be doing is you'd be waiting for either for price to form a new fractal if price rallies up, or you'd be waiting for price to sort of, if it fell down and actually sort of triggered through that particular area there. So in this particular case, having a target, well, yes, the trade was in and it worked and it's nice, but what it did is it cut me off from profits. Whereas in the particular, the trailing would have actually, you'd still be in the trade, and you'd have taken some, you'd have banked some particularly nice profits with your trailing stop profit. So as I said, there's no perfection. Okay, there's no perfection, ladies and gentlemen. It is about finding the simple way that actually works, that can actually work for yourself. So that was only one trade of mine from last week, and I have another kind of trade running at the moment, which is on dollar yen. I've got that on here, dollar yen on here. Let's have a little look on this. Okay, so Aaron's asked, how was the original stop loss calculated? Why 61 pips? Okay, that's a good question. I'm very happy. Thank you for that, Aaron. So here we go. So let's just zoom in here. Okay, let's just do this. Let's just scoop that out a bit. So why was it 61 pips? Well, what I've said is that my entry was once this had an engulfing candle here, okay, which had bounced off the 50 period moving average, which had acted as dynamic resistance before, and invariably, what I was effectively getting, I think this is like the sort of the early morning candle yet. So it would have this one completes about 11. I think it's about 11 o'clock. Okay, so literally 11 o'clock Tuesday morning. Once that new candle opens, I'm entering that trade at like 29.13. But I need to know where is my stop, where is my exit. Okay, remember rule 2: never enter a trade without knowing where your exit is. I knew my exit was that if price turned and dropped. Okay, let's use the drawing tool here. If I'd entered there and price had dropped and carried on like this, well, once price had actually broken through that level, well, my trade idea was wrong. I didn't want to be in this trade any longer. Okay, my idea didn't work, and that happens. That's just part of trading. So what I wanted to do then is just, let's have a look here. Is that just I wanted to work out, okay, well, what was the low of that particular candle? And in that particular case, the low of that candle was the low of that candle was effectively kind of 128. You can see 128.54. All right, and then I will take sort of 2 pips off that, okay, just in case there's a little bit of slippage or a little bit of movement. So I know that I'm getting in at 129.13, and I know my stop loss is at 128.52. So it's just you can either do that yourself if you've got the mental arithmetic, okay, or you can just quite simply sort of work it out, okay, in terms of just removing your stop loss from your entry level, and that gave us 61 pips of trade risk. Okay, now trade risk is the number of pips between my entry and between where I'm going to get out if I'm wrong. I hope that answers your question, Aaron. So I know I want to do that and stuff, and I want to work that out. What we'll do in the next session is we'll talk about how do we position size that, okay, in terms of how many actual units. We'll use this as a bit of an ongoing example. I think that would be it's a nice trade, and you never know. But by next week, sterling could have actually continued on, and those that would have used the trailing stop would have been very, very handsomely rewarded. But for the last couple of minutes, I said one of my other trades was dollar yen. Okay, on the 4-hour chart. Just get rid of all these drawings if you bear with me for one moment, please. So we've had this was a reversal trade, okay, in the sense we've had a really nice uptrend in the dollar especially after the kind of flash crash we had earlier at the start of the year. And then what I saw here was a 4 hour. This was another engulfing candle, key reversal candle, and just put a thing which is what we've talked about on one of the earlier sessions. I like that if we've had a nice long uptrend, it's a big old candle. I didn't particularly want to, because of the size of the candle, I didn't want to enter at the break. So what I would do is I would enter on a pullback within there. Okay, so once again, here's what we're looking at. Okay, is that my entry. Okay, let's just put that in properly here for you. Right, it was at 69. And my stop loss, okay, was basically because it's because it's a sell, because I'm going to be selling. My stop loss is effectively the high of that candle is 109.99.5, so I'm going to call that 110. My stop loss is effectively is 2 pips plus the spread on dollar yen can go out, can go between about 1 to 2. Okay, so effectively it's about to effectively, I think my stop went to 04 110. 110.04. Let's just put that in there so you've got that. Here we go. Okay. Entry. Where is it? Let's just move that out there. It just looks a bit messy there, doesn't it? So that should be stop loss. That should be entry. Apologies, ladies and gentlemen. Okay, so I know my entry is at 109.69, all right, which doesn't get triggered for about until the next day, and my stop loss is 110.04. So anyone who has got quick mental arithmetic, and they work out what the trade risk was that we had on that particular trade, okay, what we were looking at. So whilst you might be doing it quickly in your heads or hammering away at the calculator, I can tell you it's 35. You have 35 pips of trade risk. Okay, 35 pips of trade risk, and my target is down here. Okay, my target's down here at at 108.40. Okay, just bring that in. So in this particular case, I'm happy just to let that trade run. There we go. And we shall see how that operates. So there's like about 108 pips of possible profit. Okay, just doing that in my head there, and about 35 pips of trade risk. So I'm nudging that towards a 3-to-1 reward to risk ratio. Okay, and what we're also seeing is if you remember right at the start of looking at the charts, is that actually we're seeing a little bit of weakness in the dollar over the last day or so. So we shall wait and see how that particular trade plays out. So I just wanted to show, as I said, we can see that just how that trade was placed, how that when the initial trade is placed, I know where my entry is, I know where my exit is if I'm wrong, and I know where my exit is if I'm right. Okay, for those traders who might want to, for those traders who might want to be using, particularly using fractals. Okay, well, the actual the fractal here was much darker. Okay, and so. Let's just show you something here in this particular chart. So you can see the dark fractals here. So when this trade triggered, I think it's on the sort of Wednesday or Thursday, the trade triggered, and then invariably what we had was trade moved down and moved away, and actually it printed another fractal there. The thing is, if you'd have moved your stop. Okay, if you'd have moved your stop there to around about, what's that, about 109.79, so about 109.83. Okay, well actually what you'd have found is on Friday you'd have been triggered out there. You've been triggered out there for about a 14 pip loss. Okay, so in this particular case, trailing your stop loss. Okay, trailing your stop loss would have meant you'd have already been triggered out on a small loss. Whereas actually just having a sort of set and forget on a trade, I'm in the trade, okay, and the trade is about the trade's about 60 odd. well, the trade's about 50 odd pips up. Okay, so it just runs away and does its thing. So as I said, there's no perfection. And the pound against dollar trade, okay, having a trailing stop would have meant that you'd still be in the trade and would have guaranteed yourself some very nice pips. On the dollar yen trade, okay, having a trailing stop would have meant you'd have been tipped out using fractals. If you'd used fractals, you'd have been already taken out for a very small loss. Okay, so as I said, there is no perfection, ladies and gentlemen. It's a case of simply just understanding which is the way that you can trade the best yourself, which is the one that actually suits you in terms of your own personality, your own lifestyle. Maybe you're trading around a day job, okay, so you don't have the time to constantly look at charts and trail a stop. Okay, it's about being able to sort of work out how that can fit into your own particular way of living and operating. So there you go, ladies and gentlemen. There's a little bit of insight. As I said, we'll do more of these as the sessions move, more away from, let's say, the slides to more away towards looking at the charts. They give you an idea, and we can have a look at that. So I just wanted to, as I said, just to show in terms of setting up your initial trades. Okay, it's important to always you always live to fight another day, and you always make sure that you never enter a trade without an exit plan. Okay, you always know what you're looking to do, and that's actually the main things I want you to take away. And we'll do a bit more on position sizing as we go through the sessions. And next session, I think will probably be it's all about risk to reward ratios and to try and understand that. So there you go. Thanks for joining us, ladies and gentlemen. I hope you found that useful. I hope you found that interesting. Best of luck with your own trading. Okay. And as always, as I said, Tuesday morning, 10 o'clock London time, the real-time daily trading ideas. Quick 15 minutes of me talking about trade ideas setting up. So you're very welcome to join me, and if not, I look forward to seeing you next Monday, traders. Thanks very much. Have a great week.